when I first started, I used to run what I would call a 10 by 10 portfolio, where if I made a bet, it would be at 10% of assets. And I was looking to have kind of like a 10 stock portfolio if I got fully invested to put the maximum amount. So the maximum we invest at any given time is 10% of assets. So far, we have not trimmed a position because it has grown in size, because I don't want to cut the flowers and water the weeds. I'd rather water the flowers and cut the weeds. And so we have some positions that have become a much larger portion of the portfolio because they've appreciated and such, and that's perfectly fine. And so my preference is always like the 10%, but we'll do 5%, and sometimes we'll do 2%. And cash basically is that, the idea is that the first 75% of the portfolio gets invested in doubles, where we see at least a 2x possibility. Then the next 10% focused on triples. Then maybe the next 10% on 4x's, and the last 5% as 5x's. So that's typically how, basically the idea is that as you get more compelling ideas, you're willing to go deeper into. So for example, during the financial crisis, at the absolute depths of the financial crisis, it would make no sense to hold cash. You really want to get to fully invested at that point, because you've just got pretty much the best possible playing field to put money to work. And subsequently, as those positions get sold off or get full price, then your cash will build up again and so on. So that's basically how we try to run that.
Mr. Pabrai, in your book, you talk a lot about risk and uncertainty. Can you talk about how you distinguish between risk and uncertainty as it pertains to stock price?
Arvind, can you repeat that? I didn't fully get that.
Sure, Mohnish. The question was, how do you disentangle risk from uncertainty?
Risk and uncertainty are two different things. And one of the things that works to the advantage of investors is that markets hate uncertainty. So markets will really punish companies which have uncertain outcomes. And it's always fun to play these uncertainty games. So let me give you a real example, which is in my portfolio right now. So there's a company called WL Ross and Company. The ticker is WLRH, and it was set up by Wilbur Ross, and it's a blank check SPAC company, basically, where they raised about 500 million, and pretty much all the cash is sitting there, and they have to do a deal in a couple of years. And if they don't do a deal in a couple of years, then the cash comes back to investors. And so, in fact, the unusual thing about the Wilbur Ross company is that even the investment banker underwriting fees get refunded in the event the money is sent back. So, the guys who did all the work for the IPO and such, most of that would come back too. So basically, the company has pretty much $10 a share in cash, and the stock is at $10. And in fact, when we bought it anytime it went below $10. In fact, we usually bought it below $9.97, so that even with commissions, we were below $10. And so we were buying a dollar bill for slightly less than a dollar bill in that case. And Wilbur Ross is a tremendous value investor. He's, I would say, deep distressed value. And so the uncertainty in that stock is we have no idea what business Wilbur Ross will invest in, or what industry he will invest in, or what the economics of the investment will be. We also don't know whether he's going to fail to make the investment, in which case the money comes back to us. And so there's a lot of uncertainty in that stock. But when you look at risk, the risk is for the most part non-existent. Today, there isn't much risk because you've got cash against what you paid. And how would you lose money? Well, you would lose money if Wilbur made an investment that ended up being a bonehead investment, where it turned out to be terrible. And the batting average of Wilbur Ross is so good that I would say that the odds that you have a significant permanent loss of capital in an investment that he would make is very low. And there's another ticker with the same stock, which is WLRHU, which gives you a share of the stock and also gives you the option to buy another half share I think at like the equivalent of $11 a share or something. So that has a kicker in it as well. So this is an example of risk being low, uncertainty being high, and markets not liking that. Right?
You may have heard Mohnish Pabrai talk about his portfolio allocation strategy. It's simple but brilliant. He puts around 75% of his money into stocks where he has very high conviction. Stocks he believes can at least double. Then he allocates 10% each to ideas he thinks can triple or can be a 4x. And the final 5% into potential 5x winners. The key idea here is bet big where the risk is low and conviction is high. And put the smallest money into the most uncertain bets. This way, if he is wrong, the damage is small. But when he is right, the upside is massive. This is where many investors go wrong. They put too much money into high-risk potential multibaggers. Pabrai does the opposite. Protect the downside, and the upside takes care itself. Even with a concentrated portfolio, this approach keeps risk under control while still aiming for a big return.